everybody. It's another, wait for it. It doesn't say Taxes Retirement Live. Well, it's Taxes Retirement Live. I'm your host, Andy Panko. Thank you for joining me. Sorry, I am a minute late here from what I see. Apologies. We got a fun one tonight. Tonight is another mailbag, monthly mailbag episode. The first Wednesday of each month for this year will be the fantastical mailbag edition. So I did receive 2 questions in advance, which I'll go over first, and then, as always, free for all with the rest of your questions. I just ask that for those of you, typically people will, as someone posts a comment here, others will reply to that comment. I ask that you all hold the replies if possible, so I can see as questions come in, I can see them as questions, as opposed to it gets jumbled when I see responses to questions because I don't see in my software what's a response to a question versus what's its own post. So if I can just ask you all to please refrain from answering other questions if that's okay. So comments are working. Hello there, Mark. Thank you for joining. David Fultz with the full sentence, 1 word full sentence with proper punctuation. Cody Garrett, mail time. Oh man, Cody, you hit more of my pet peeves. If you're going to use multiple exclamation points, do 3. Either do 1 or do 3. What's this 2 stuff? Now, I'm not an English major, so I could be way off on this. English was actually my weakest subject throughout my schooling. But anyway, maybe it's just me. 3 exclamations or none, or 1. Actually, no 2, Cody. There you have it. I know Cody's also a fan of the Oxford comma, I think it's called, which I'm not. But neither is right nor wrong. All right, again, mailbag tonight. Let me do the disclaimer. Oh, no, dad jokes. What am I doing? I'm out of form here. Dad jokes for this evening. What's blue and smells like red paint? Blue paint. Seriously, all paint smells the same. I didn't think about it until I saw this joke. The joke's not that funny, but I was like, oh yeah, paint is paint. Doesn't matter what the color is, unless you infuse it with like some sort of flavoring or essence. Next. A bossy man goes into a bar. He orders everyone around. And finally, you know what? You know what I'm queuing up here. My sidekick, my Ed McMahon, my Paul Schaefer. Did you hear about the restaurant called Karma? There's no menu. You get what you deserve. Makes sense, right? I like it. You get what you deserve. Okay, let me disclaimer now. If I can find it, I can definitely find it. Here we go. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Thank you. 1 exclamation point, Cody. Just 1, maybe 3, but not 2. Thank you. So I am not your tax, legal, investment advisor tonight. I'm just some random guy on Facebook answering questions. But to the best of my knowledge and ability, I do obviously genuinely hope that I'm giving accurate information or information I believe to be accurate. I cannot guarantee the thoroughness, completeness, or accuracy of what I'm about to say tonight. If I don't know something, I'll gladly let you know, as you all know. But if I do think I know something, I will tell you that with confidence. But again, no guarantees that what I'm saying is indeed accurate. So do not take any of this as specific advice, recommendations, or otherwise. Okay, first question. This is an easy one. It's an easy one because I don't know it, so we'll be able to do it quickly. This is from Sharon. I'll parse through and pull out the stuff here. It's a question about a 1031 exchange. So when you own a real estate property that you rent out, normally when you sell it, you would have to recognize any gain you have on it if you sell it for a gain, and any depreciation that you expensed or could have expensed while you owned it and used it as a rental. You have to realize that amount of accumulated depreciation as ordinary income up to 25%. So fairly complicated rules. Not tax advantageous to sell rentals. When people have rental properties, they think it's great because you can deduct expenses, which obviously people know of. But the other thing that seems like a freebie is depreciation. Depreciation is a non-cash expense. It's not actually money you pay. Yet from an IRS, from a tax perspective, depreciation is something you get a benefit for along the way because it's counted as if it's an expense. And depreciation is simply the concept that something has a useful life, and over the years, that useful life slowly depletes. And you can recognize that depletion of the value over the useful life. You can recognize that depletion as an expense you don't actually pay cash for that expense. It's a non-cash expense, but you get the tax benefit for it because that depreciation expense reduces the taxable income you'd otherwise have on that property. So it seems awesome while you have the property. Then you go to sell it. Then it bites you in the rear. All that depreciation you expensed or could have expensed along the way, you have to pay tax on when you go to sell it. So you're not actually getting anything with those depreciation expenses. So a 1031 exchange in a nutshell, and I'm far from an expert, and I will defer to someone who does specialize in this, but a 1031 exchange is simply when you sell one rental property. Normally, if you sell it outright, you'd have to realize any gain and the depreciation taxation you'd have to recapture. If you roll that sale proceeds into another comparable real estate property, you can continue to defer the recognition and realization of the capital gain and or the recapture of depreciation. So that's the gist of it. There's a lot more to it than that. You have to pick a certain amount of properties within a certain time that are target properties that you want to buy with the proceeds of your sale. You need a qualified 1031 intermediary to hold the proceeds of the sale. You can't just get cashed out like normal. There is this formal process and structure around doing a 1031. And again, I'm never did it, nor do I have interest in doing it. So I'm far from an expert. But the question basically is, Sharon owns with a partner. They each have 50% share in a beach house in my lovely state of New Jersey. Want to sell it. Curious how a 1031 exchange works. They know that if they sell it outright, there's going to be tax. And for those of you who aren't aware, properties in lots of areas of the country have gone up a lot, especially beach properties. This is a prime location property, has gone up substantially from where they bought it. So there's a lot of gain on this property and the depreciation to be recaptured and realized. So basically asking about 1031s. Do we need to know ahead of closing on this property if we are going to buy another rental property? And if so, what do we need to spend? I have no idea what will make the most sense of us in terms of tax planning, which is why I'm wondering if the decision has to be made beforehand. So yeah, there's a lot of things to consider. If you're doing this purely to defer taxes, this is just my opinion. I don't know. I don't think you can, in my view, you can't view this purely as a dollars and cents thing. You have to parlay this money into another rental property. So unless you genuinely want to stay in the landlording business, Sharon, don't necessarily let the tax thing drive this for you, because you're not getting rid of the tax, you're just deferring it. So when you eventually sell the second property you're going to buy, if you roll that second property to a third property, at some point you got to pay the piper and sell it, pay the tax on it. Or under current legislation, if you take this house to the grave with you, or whatever house you roll it into, there can be a step up in basis. So you leave this house to some heirs. Those heirs would get it all tax free. And I don't know this with 100% certainty, but I'm fairly certain, even in the case of rental real estate, that even like the depreciation that you'd have to recapture also goes away from a tax perspective in the hands of whoever eventually inherits this from you. So if you think you can ride out being a landlord for the rest of your life and you want to leave this property to whomever your heirs are, maybe that's something to consider, in which case, yes, maybe you just keep rolling this thing from one 1031 to another. But if you don't like being a landlord, you don't want the headache, the potential hassle hanging over you anymore of getting tenants and renting this out and whatever, then maybe you just bite the bullet and sell it and deal with the taxes. I mean, having to pay taxes means you made money, and that's fundamentally a good thing. But I agree, obviously, you don't want to have to pay more taxes than you need to. So that's my thoughts on that. Short answer is I don't know. Definitely reach out to and try to find a qualified 1031 specialist, which I don't know any currently, but I did reach out, Sharon, as I said I would, to another advisor network I'm in to see if people have recommendations. So that's 1031. The other question, let me just see. I did get a Facebook message request while I'm sitting here. I want to see if this was someone with a question. Give me un momento, por favor. Message request. Yes, it's a big one. Okay, I don't even know what he said, but it's a question. I'll hold that next. Let me get to the other question that came in. Mariel Sitman, question for tonight's mailbag. Assuming same holdings in each, discuss pros and cons of index funds versus ETFs. Thank you. So I'm assuming, Mario, you mean mutual funds versus ETFs, because you can have index funds in mutual fund or ETF flavor. So my guess is the question is less about index funds versus ETF and mutual funds versus ETF. So index funds, there's a general classification for some sort of pooled holding, whether it's a mutual fund or an ETF, where the things that fund invests in is just simply a collection of securities meant to replicate or track some index like the S&P 500, for example. So you can have an index fund where it holds 500 securities, essentially, the 500 securities that are in the S&P 500, and you can have it in mutual fund flavor or ETF flavor. So the question, I guess, is really the difference of what's mutual fund versus ETF flavor. So I won't spend too much time on this. I did have a standalone video in the YouTube channel where I addressed this in one of my like 15-minute shorter videos. You can go back and check that. And I did a whole live dedicated to this topic. I don't even remember when, some point last year, I think. So you can see the replay of that. But in a nutshell, I'll see if I can rattle these off quickly. That you can both have the identical exposure. Like Vanguard, for example, will have the exact same portfolio of securities. You can buy it in two different flavors, mutual fund flavor or ETF flavor. So the question then, what's the difference? Well, with the mutual fund, the similarities are they're both a pooled vehicle. Investors put their money in, pool it up into a big fat pot. The big fat pot goes out and buys all the securities. Everyone who owns a share of the mutual fund or the ETF owns a prorated slice of that pot. That's the similarity. The difference is a handful of things, I guess. Mutual funds, you can only subscribe to and redeem from directly from the fund company. They don't trade on an exchange. You buy it to and from the fund company. You can only buy it as of close of business prices on any given day. So you can't buy and sell a mutual fund intraday. You can place the order intraday, but the price at which you buy or sell it will always be at the end of day value of the fund, which is called NAV, net asset value. There's no deviation from net asset value. You will always buy it and sell it at whatever the net asset value is that day. And net asset value is simply the sum of the value of all the securities minus any debt the fund may have outstanding. What else? Pros and cons. Whereas with ETFs, you don't buy them directly to and from the fund company. You buy them like a stock. You buy them and sell them on an exchange. Because they trade on an exchange, not directly to and from the fund company, there can be what's called bid-ask spread. The price at which you buy and sell is going to be slightly different. And that's how stock market makers and ETF market makers make money is they sell to you at one price and buy from you at another price with a slight difference in between. So for those of you that trade actively, day traders in and out of this stuff, this differential in the bid-ask spread could add up if you're constantly getting in and out of ETFs. If you're a buy and hold investor, the difference is going to be negligible. You're not even going to notice it over the long term, especially if you're just buying, holding, rebalancing once every few months or something. And with the larger, more liquid, big ETFs where there's lots of people in it, billions of dollars of assets behind it, the bid-ask spread is going to be so tiny that this functionally doesn't matter, practically doesn't matter. Tax efficiency, ETFs win hands down, and this is a separate topic, but the way they're structured and how securities get to be redeemed or sold out of the fund, it greatly minimizes, if not completely reduces in many cases, the taxability of the transactions within the fund. So long story short, if you're going to hold an investment in a regular taxable brokerage account, ETFs are generally better because there's minimal to no risk of getting unwanted capital gain distributions passed through to you, which commonly happens with mutual funds. So ETFs, you don't have that. Now, if it's an index fund, it's passive. Chances are the capital gains passed through to you will be tiny, but stuff can happen. Like last year, there was really large capital gains passed through on Vanguard target date funds that took a lot of people by surprise. There's an article in the Wall Street Journal about it. Long story of why that happened, but it happened. So there were some target date funds that paid like a 15% capital gain distribution. That's a very unwelcome tax surprise that a lot of people got last year, whereas you don't have that with ETFs. I guess I'll leave it there for now. The one other thing to say is depending on the strategy you want to invest in, if it's an index fund, it doesn't matter. I'd lean towards ETF, but if it's an actively managed strategy, almost certainly you're only going to find it in mutual fund flavor. ETFs were kind of created to be passive index-based strategies. Not to say there's not some actively managed ones. There are actually, and they're increasing in number. But the vast majority ETFs are just indexed passive. They try to trace some index or sector or something, whereas mutual funds are indexed and actively managed, more tactical sort of strategies. Hope they answered the question. Definitely check out my other videos. They'll do much better justice to it, including pretty charts that detail all this stuff out for comparison's sake. All right, the other question that came in, let's see, I haven't looked at this in advance, so let's see what happens. From Frank Anthony, question for Mailbag. I'm working on my withdrawal strategy. The plan is to take Social Security as late as possible, 70, but replace this income with IRA withdrawals, as well as some Roth investments, albeit these funds are limited. When Social Security kicks in, I will reduce my investment income, except for RMDs, which I'll have to take. I also wanted to fit in some Roth conversions, but there appears to be no opportunity to do so. All I can think to do are a series of small conversions on a year-to-year basis, closely monitoring income versus tax bands. Any suggestions? Question mark. And then there's a second question, but we'll hold that. Yeah, man, that's a big one. Tax efficient withdrawal strategies. I also did a video on that. I don't remember when, but did a whole night topic, a whole live episode about that. You're thinking about it the right way. It could be generally as good tax planning. If you're delaying Social Security, you're going to have periods of low income. So you stopped working at 60, let's say. Your wages went away. You're not yet taking Social Security. Assume you don't have a pension, or if you do, you didn't start yet. So your only income is going to be a little bit of dividends and interest. I don't know, whatever, gambling winnings. Point is, it's going to be tiny. So you can have a lot of control over the taxability of your income. That's the sweet spot. Those years, typically in your 60s, could be the sweet spot to get ahead of your tax-deferred balances, like your IRA. Instead of just letting it sit there, snowball and grow to be forced upon you when RMDs start, you can control, or at least have a lot of control, over how and when you recognize that income and its taxation. So yes, so you can pull out, depending if you're married or single, 60 grand, 100 grand, 120 grand of gross distributions and fill up your 12% federal tax bracket and maybe a little more. That's a good way to make tax efficient use of those tax deferred monies. If you don't need the money to live on, you don't want to do distributions, then sure, then you can do conversions instead. The objective is still being met of trimming down your tax deferred balances to help minimize RMDs down the road. Just looking at the other thing here. So all you can think of is do a series of small conversions, closely monitoring income tax risk bands. Yeah, it's basically it. You just kind of pay attention to your tax brackets and know what you have in mind. If your goal is to fill up the 12% tax bracket and no more, then as a single person with standard deduction, that's going to be 57, 58 grand of gross income. Fills up your 12% bracket for 2022. If you're married, take that to $109,000 of gross income. Fills up your 12% tax bracket. Add a little more to that if you're 65 or older. So those are good opportunities. Don't let those go to waste, especially if you have sizable tax deferred balances. Do not let your 10 and 12% bracket go unused. Frank, good question. I'll leave that one there for now. The next other question from Frank. A couple owns an investment property. They agree to sell and each take half the proceeds. Can one perform a like-kind exchange and the other take cash and pay their portion of capital gains? So I guess this is in regards to 1031. Can one half owner of the property choose to do a 1031 exchange and the other not? That's a good question. I never thought about it. I don't know. I really don't know. And this also applies to Sharon's question, I suppose, because Sharon owns that property jointly with another person. That may prevent you from doing, I'm just thinking out loud. If the other person isn't on board with doing a 1031 exchange, that might possibly prevent you from doing it. If you're only a partial owner, my guess is it needs to be all or none, but I really don't know. That's definitely a good thing to ask prior to deciding whether or not this is even a strategy for you, Sharon and Frank. All right, that's it. Thank you for the question there, Frank. Hopefully that answered it. That withdrawal strategy one's a big one. There's no short answer to that, but the quickest takeaway is yes, the years before Social Security and or pension starts and after wages have stopped, great tax planning window of opportunity to get ahead and spend down or distribute some of your tax deferred monies. All right, that's it for the preloaded questions. Let me mosey on over to comments now. Okay, let's see what we got here. Questions. Cody Garrett shared a link to a one-page 1031 exchange summary. Thank you for that, Cody. Cody Garrett sharing a link to the mutual funds versus ETF video. Thank you. Facebook user, do I need to file an 8606 form if all of my traditional IRA, oh, here we go. Looks like this was the rest of it. Sorry, do I need to complete an 8606 if all my traditional IRA is pre-tax when I convert those funds to a Roth IRA? Yes. You will still have to do the form as part of your conversion, but the end result is going to be 100% of the conversion is taxable if all the money's pre-tax. I don't know. It's good practice to do it. I can't say with 100% certainty that the form is absolutely required to be submitted. You probably should anyway, just to show, yes, I did the calculation. But where I'm going with this is, if you're already claiming all this conversion is taxable, I don't know that the IRS is going to want to proof check you and be like, no, show me that it wasn't. Show me that some of it wasn't actually taxable, right? They're not going to tell you that. They'll be happy that you're paying more tax than you should, even if it's to your detriment. So I don't know that you have to, from a sense, like the IRS may not care if you submit it, if you're claiming all of it's taxable, but I would still do it anyway as good practice. Just to confirm that everything's there, and it's probably the right answer to do that and submit it with your tax return anyway. Good question. Okay. What is Fidelity Zero Funds? I'm assuming this is just in reference to Fidelity does have some ETFs that have zero expense ratio to them. I don't know if they have a mutual fund flavor or just ETFs, but there are some funds that do have zero expense ratio to them. That's, I believe, what Fidelity Zero Funds are. I guess this is Frank. Thanks for the answer. I do have a pension and I'm single, so the tax bracket is tight. Yeah, good problem to have. I'll gladly take a pension any day of the week. But if you have a pension, traditional pension, once that's on, that's not going away. Let's hope it doesn't go away. So that's always going to crowd out a decent chunk, if not all, of your lower tax brackets. And that does take away some opportunity to start trimming down, IRAs on top of it, unfortunately. Again, good problem to have. So always keep that in context. But yes, it does make your tax planning opportunities that much smaller. Frank, I'll assume that was Frank. Yep. Okay. So whoever this was, in regard to Fidelity Zero, some funds have zero expense ratios, whereas Vanguard, like their index funds are, depending on the fund, like the S&P 500 fund, I think is 0.035% fee. The international stock fund is 0.07, I think. The bond fund is like 0.04, perhaps. So still quite cheap. I mean, we're talking fractions of a percent, but not true zero like the Fidelity funds. But the zero funds have much fewer number of companies in their index, in my opinion. Not worth it. Okay, I didn't even know that. I didn't look into the Fidelity funds. They're relatively new, but apparently they do have different holdings than other funds. So thank you for whoever brought this up. What is the largest tax deduction or savings you've found for a client? Oof. I don't know. I mean, the low-hanging fruit is stuff like charitable deductions, especially last year and this year. So even for people who take the standard deduction, you can still get the benefit of either $300 or $600 if you're single or married of cash charitable donations you made during the year. So that's an easy one. Just simply ask, did you have any donations? And in some cases, yes, clients did, and they forgot to mention it. So that saved, all in, I don't know, $100 in tax, maybe, depending on the client. But it's something. I'm trying to think of anything like massive. So I'm working on one now. Not to get too off track here, but it's not an easy one. Client in New Jersey, basement flooded as a result of Hurricane Ida remnants. That was a federally declared disaster. And if you sustain damages and insurance doesn't cover all of it, you can deduct the amount of damages not covered by insurance if it happened as a result of a federally declared disaster. You can't do it simply because a storm drops a tree in your house. It's got to be a federally declared disaster like Hurricane Ida was. So she has a quote from FEMA saying how much the damage was, and she has an insurance payout, which is only a portion of what the damage was. Now the difficulty is there's like a lot of subjectivity in here. You have to figure out what the basis or depreciated cost is of the personal effects that were damaged. Standalone armoire or whatever, dresser thing, couch, chair, coffee table. You can't claim a deduction for more than your basis, your value in those things. And personal effects like couches and coffee tables that are 10 years old, they're worth close to nothing at this point from a tax perspective. Like, yeah, you may have paid $5,000 for them at the time, but they deplete down. They have useful lives. So my struggle now, and it's ended up being more time than I hoped it would, is trying to come up with a way to figure out what is the defensible current depreciated value of these things, because that's what her deduction is going to be based off of. So this doesn't quite answer the question. I mean, if I was a underhanded person, I would take advantage of this and fudge these numbers, which I'm not, and I don't want to get in trouble, and I don't want to hurt you either. So now I'm struggling to figure out, how do you value a 7-year-old couch and a 10-year-old armoire? I don't know. So this is turning out to be a lot more than I thought it was going to be. But anyway, this is going to end up being a large deduction for her, but she already knew she'd be able to get a deduction for some of it, but she didn't know how much. So I'm the one now figuring out how to do it. But such is my job, I suppose. I don't know. I don't have a great answer for this one outside of that. Nothing's coming to mind. It's not like I ever had this, I just saved someone $5,000 because they missed something dumb. No, usually it's nothing like that. As much as TurboTax and H&R Block want to make it sound, unless someone's doing something sneaky, chances are you're not finding that big of a deduction. If anything, what you're doing is helping clients avoid income or additional taxes getting missed. That's a lot of what it comes down to often. Otherwise, you're asking about charitable donations. You're asking about like medical expenses, medical miles driven, even miles for charitable things could potentially be deducted. So things like that can save a little bit here and there, but oftentimes they're not going to be like revolutionary. Good question though. I have non-deductible contributions in my IRA from the 80s and never filed an 8606. So I have to go back and file amended returns, or is there another way? So yeah, this one comes up a lot. I don't know that this is the formal response from the IRS. So maybe even been Jackie said this, I don't recall. Someone said that, let me back up before I even say that. So the widely accepted process within the industry is, yes, it's quite common that people forget to do 8606s or have them incorrect for previous years or whatever. So instead of going back and fixing every year retroactively, you can just start with this year going forward, start with a proper, correct, clean one. So whatever your actual amounts should have been historically, maybe you botched them along the way, do the homework, get them figured out now, so you can start this year's with a proper, carried over number. Then going forward, make sure you do this 8606 every year with the appropriate adjustments year by year. If you do conversions, that changes it. If you do distributions, that changes the math. If you add additional non-deductible monies, that's going to change it. So you can apparently just start this year with a correct one and do it going forward. I think it was Jackie, I don't recall, someone said that's what they did, and the IRS actually, no, it wasn't Jackie, someone else, never mind. The IRS actually acknowledged and said, yes, that's okay to do. Prior to me hearing that, my understanding was the IRS has never said it is or isn't okay, but they've never really poo-pooed it either. So it was safe enough to do. Worst case, the IRS, what they have put in writing so far is that you are supposed to amend every year retroactively, and there's a $50 per year fee to do one of these 8606s retroactively. So the advice was just do a new one starting this year. Worst case, the IRS flags it and says, nope, you got to do them retroactively. Then you go back and pay the stupid $50 per year to redo them. Otherwise, just start fresh, hope for the best, and you should be okay. So that's that. Jackie, can you talk a little about the process of getting your podcast going? I know you have amazing content and knowledge. Thank you, Jackie. Just wondering about the behind the scenes and how easy or hard it is. It's really not that bad, actually. I'll just touch on this briefly because I don't know. I assume most other folks in the group aren't particularly interested in this, but it is a cool question, I think, Jackie. So you need a few things. You need a good microphone. So I got a good microphone. You need to have an idea of what you want to talk about, obviously. Then you just kind of sit down and let it rip. Now there's some software you'll need. I have two different softwares. One, you'll need a hosting platform. I use a company called Buzzsprout. I did some research online. They seem to keep coming up as like one of the better, easier to use ones. So your hosting platform is where you upload your finished audio files to, your finished episodes. That hosting platform is what then pushes it out to Apple, to Google, to Stitcher, to Amazon, to Pandora, to Spotify, to whatever other platform you're getting your podcast on. So the hosting platform isn't where people actually go to find and download. Yes, there'll be links where you can listen live on the website. Like when I send you my Buzzsprout link, that's what you're doing. But Buzzsprout, most people don't find podcasts that way. They go to Apple, to Google, to Spotify. So Buzzsprout pushes it out to there, and you can set up the schedule of when you want stuff to get released. So I already have like 3 episodes canned up, queued to get released every Thursday morning at 1 a.m. Eastern time. So there's a new one coming out tomorrow morning, or tonight, actually, overnight. So that's the hosting platform. And then you need some sort of process or software to actually create the audio file. So I subscribe to an online cloud software called Alitu, A-L-I-T-U, and I'm not specifically recommending it. It's just another one. Seemed easy for a dummy like me who has no AV background. Seemed easy and user friendly. You basically record your audio files, you dump them in there, and then you got to also record like an intro and an outro if you want it. So I paid some woman on Fiverr, a professional voice woman, to record my intro and outro. So she gave me those audio files, and basically you just drag and drop. So I have like my teaser, I have my intro audio of the woman talking, I have the body of my episode, and then I have my outro, which is also the woman talking. And you just drag them all how you want them. You can click to make little transitions and stuff. And Alitu produces your final complete audio file of the episode. That audio file, then Alitu links to Buzzsprout. That audio file feeds to Buzzsprout. Buzzsprout then pushes it out to the different podcast platforms. So that's kind of it. As long as you have something in your head to talk about, which, as you can tell from all this stuff I do on Facebook, I just, this content's here already. So I figured, why not just sit in front of a microphone, talk for a half hour, hit record, and also put it out to the world in podcast format. So that's what I decided to do. But if you don't already have content schemed up, Jackie, it's going to be a lot of work to sit down and think about what you want to talk about, make outlines, and actually, get it out of your head and into a microphone. But otherwise, the process isn't that difficult, even for someone with limited AV knowledge like myself. Zero podcasting knowledge prior to looking into this stuff, a few weeks ago. All right. Please discuss education deductions credits for college age dependents. Oof, man, this is not my strong suit. 1 second here. So within tax, there are specializations like any other professional field, like doctors, like lawyers. There's general practitioners, there's heart surgeons, there's chiropractors, there's whatever. I'm an IRS enrolled agent, which required me to pass a few exams and do continuing education. And those exams did test me on things all over the tax map, including education credits. But I've decided to focus my professional efforts on retiree-specific things like Roth conversions, IRAs, withdrawal strategies, how pensions, how Social Securities are taxed, how annuities are taxed. I know nothing about international tax. I know not much about business taxation because I choose not to. So most of the people I work with are typically retirees. If they do have kids are usually grown out of college. So I frankly don't come across education credits much, if at all. So I'm really rusty, and I don't know these nearly as well as most other folks will. I forget. There's something called the lifetime learning credit, and I forget the rules. There's also one called the American Opportunity Tax Credit. One of them you can only use for up through college. One you can also use for grad school. One does have an age cutoff to it. So I really don't know. Whoever this is, I'm sorry. So there's a lifetime learning credit. Definitely look that up. There's the American Opportunity Tax Credit. There's also, you can deduct interest on like student loans. If you have student loans, interest could be deducted perhaps. I gotta stop there. I don't stay nearly, I don't stay on top of these education related credits. My kids aren't of education credit age yet, so it hasn't really played into my life personally. So I don't know. Sorry about that. Whoever asked this. Okay. Epic fail on my part for not knowing this one. Dave Fultz, is the possible raising of RMD ages going to matter much for folks? So what Monsieur Fultz is referring to is there was legislation put forth some point last year called the SSA secure. I forget what it was. It didn't get passed ultimately, but in it, one of the things was increasing the RMD age from 72 to 75, and it'll be done over this phase, like 10-year period. I think it doesn't just jump. It's like it'll be 72, then 73, then 74, and ultimately 75. Again, it didn't get anywhere, so who knows if it'll ever resurface. I don't know if it's going to matter. I think RMDs are dumb, honestly. I mean, I know why the IRS does it. They don't want people deferring taxes forever. Uncle Sam wants his bite, and he wants it, sooner rather than later. But realizing people are living longer and people don't necessarily need the money in their IRAs, there's been pushback about RMDs in general, or why they're happening at such early ages. I don't know if it's going to matter. I mean, in theory, it gives you a few more years of tax planning to get ahead of your RMDs and trim them down to the extent you can or you want to. But I don't know. I have mixed feelings about RMDs. It'll help some people. For some people, it won't matter. Some people do already take out more than their RMDs because they simply need the money to live on, in which case it doesn't matter whether it's 72, 75, it's not going to phase them. For other folks, sure, I guess it's a nice little benefit to get ahead of with some tax planning. Do you help clients consider moving to a low income state? That would be a big savings for some. Sort of. Like I'll never say, hey, I think you should move to Texas simply because it's cheaper, from an income tax perspective, at least. Other things are more expensive. That has to start with the client. There's more reasons than just taxes. Usually it's around where friends or family are. It's driven by weather. It's, those are the big ones, but also access to healthcare and things like that. Yes, obviously taxes matter. It shouldn't be the sole driver. For some people it is, but shouldn't necessarily be the sole driver. If people do have questions and they're already considering moving, then sure, then I help kick it around. I mean, the easy ones are Florida, Texas don't have state income tax. There's a reason why those are fairly popular for retirees, but you pay for things in other ways. Like Texas has relatively high property taxes, for example. And I'll help with that discussion. So I do have a client that just moved from California, retired to Texas, largely for tax reasons. California, not a cheap state from a income tax perspective. Texas, very cheap state from an income tax perspective because taxes are zero. So yes, those are definitely discussions we have. And it does play into, like, if a client's going to do Roth conversions, for example, it will be better to wait and do the conversion in the no tax state than it is to do it in a state like California, where you're going to pay high single digit % on it, depending what bracket you're in. So if you plan on moving halfway through the year, you want to do conversions, wait until the end of the year, save yourself the state income tax. That right there is, a 5, 6, 7% tax savings, which is real money. So yes, these are things I talk about, but I don't drive the discussion of, hey, I think you should move. The client already has to kind of want to move, in which case I'll then help kick around the pros and cons to the extent I can. Yes, Mark Troutman sharing some more info about the tax credits. Thank you. Tressa Wood for the 8606 question. Suppose you started with 8606 a few years ago, then still did a 8606, but the basis wasn't brought forward from the prior year, so fully taxable for 3 years. Upon realizing the problem, is the basis the same as it was from the last successful 8606? Ooh, the plot thickens. So I see what you're saying. So you erroneously paid too much tax for a few years because you were not counting all the basis you should have. So now what do you do? I don't know. What you're saying, what you're proposing, Teresa, sounds logical. You're not cheating the IRS. If anything, you cheated yourself by paying too much tax. Now you're just realizing it and sort of picking up where you left off. That feels like the right answer. I don't know the right answer. That feels defensible. I would think that's okay to do. If ever questioned, just explain what you did and why. I would hope the IRS will be okay with it. Worst case, they're not. Then you have to go back and amend some returns. But it feels like this is in the spirit of what should be allowed. I don't know the actual answer. Have you worked with someone who retired abroad? Can they arrange filing tax from abroad? What will be the common problems as far as taxes are concerned? I don't get involved in international matters. Again, that's one of the areas like I choose, because that could be a whole can of worms. So I choose to not have clients that have that angle. So therefore I don't have to focus on that whole other skill set and knowledge base. But yes, you can you file from abroad? If you're filing electronically, sure, I would assume so. I mean, the filing is going to be done by whoever's doing the taxes. So like, let's say you have someone prepare them. That preparer is filing it from the US IP address. They're the ones submitting it to the IRS. That should be fine. The fact that the client is physically in another country, when he or she, there's a form he or she will have to sign to permission you to e-file. That can be docu-signed. There needs to be knowledge-based identity verification along with it, like ask you questions from your credit report. So maybe that could possibly snag it. Like if it knows you're in a non-US IP address, you may fail the DocuSign verification process, possibly. You didn't hear this from me, but the quick workaround would just be get like a virtual private network where you can log in through a US-based IP address. That could be one way to resolve that, I suppose. I don't know for certain. But I really don't know, because I know international matters could get hairy, especially if you own property abroad, if you have income abroad, if you have to file taxes in the other country, then it's like, depending what reciprocity there is between states or tax treaties between countries, this could get messy, and I choose to not get involved in that. So I'm really not sure. But I think you can file still your U.S. taxes. As long as you're a U.S. resident, U.S. citizen, you need to file a U.S. tax return regardless where in the world you live. So there's got to be some way to be able to do it. I haven't had to cross that bridge. Thank you, Cody. Some more about the education credits. Do you save FICA taxes when you contribute to HSA through employer instead of directly contributing from your own checking account? Most times, yes. So specifically, the employer contribution needs to be part of what's called a Section 125 cafeteria plan. If it is, then yes, then your contributions to the HSA through your employer will reduce your wage base on which FICA taxes are collected. So in addition to saving income taxes, you're also saving FICA taxes. Now, there could be cases where you are contributing through your paycheck, but not technically to a Section 125 cafeteria plan, which is IRS speak for how this plan is structured. In that case, no, those contributions will still reduce income tax, but they will not reduce your FICA tax base. So something to keep in mind. But to my knowledge, the vast majority of HSA plans through employers, I do believe, are through the Section 125 cafeteria plans. Therefore, they will get you the FICA tax deduction. But that would be best to confirm with your HR to see whether or not it is indeed a Section 125 cafeteria plan. So Teresa asks, is someone taxed in the U.S. who works for another country, say Australia or New Zealand, remotely from the U.S.? Is that income taxed by the U.S.? So yeah, this is where it gets messy, and it depends on the country. Generally speaking, yes, if you're a U.S. citizen, regardless where in the world you are, if you have income, you're supposed to report it as U.S. income and pay U.S. taxes. However, there's a bunch of different credits, exclusions, and sort of tax treaty reciprocity. So some of the credits, for example, there's a foreign earned income tax exclusion or foreign earned income exclusion. I forget what it's called. If you live abroad and earned income, you can exclude some of that from your U.S. taxation. And I believe the underlying premise is that, well, you're already paying taxes in the country you're earning it because they're taxing you for it. So the U.S. tries to be nice and doesn't tax you twice. There's some other foreign allowances, like if you get a housing credit or something, you can deduct that on your U.S. taxes. Outside of that, outside of earned income, for example, in a foreign country, if you simply live in Australia and you have a bank account there or a brokerage account and earn dividends or interest, by default, yes, the U.S. will want to tax you on that because you're a U.S. citizen. But depending on the country, again, there may be some sort of treaty where whatever tax you pay in the foreign country will exempt you from having to pay tax on the income again in the U.S. So definitely, if you are thinking of moving to a different country, make sure you get in touch with a tax person who is well-versed in international cross-border taxation between U.S. and whatever country you're going to, because each country can and will be a little different in how stuff is handled. And I'm definitely not the person to talk to about international tax matters. Florida has no income tax, but medical insurance is expensive. Yeah, states don't operate for free, right? If you're not giving the state revenue in one form or fashion, you're doing it in some other way. And I don't know all the angles. Yes, Florida, no income tax. Property tax, I don't think is crazy expensive. So where do they make their money from? I'm not entirely sure. Maybe it's like, I don't know, taxes on like hospitality and leisure, like Disney and Universal. Maybe they pay a lot of taxes towards into the state coffers for Florida. That helps offset the lack of income tax. Road taxes, road tolls, I don't know. So states make up for it in one way or another. Just because there's no income tax doesn't mean states are a tax slam dunk. There's still sales tax to worry about, local tax, property tax, registration tax on things like cars. You may be $500 a year to register a car in some states. You got to factor in those things. It's not all about income tax. Tennessee has low property tax and no income tax, but we pay just shy of 10% for sales tax. There you go. Case in point. I couldn't have set this one up even better if I tried. Yeah, so you're paying for it in the way of sales tax if you're not paying for it in income tax. Can you explain the Roth conversion ladder? Sure. So generally speaking, if you do a Roth conversion, and this applies to people who are well under 59.5. And here's why. So if you do a Roth conversion and that conversion was taxable when you convert it, meaning assuming you converted pre-tax money and you're under 59.5, you can't take out the amount converted for 5 years or until you turn 59.5, but 5 years or until you hit 59.5. If you do, there'll be a 10% penalty. So Roth conversion ladder is, let's say you're 40, you plan on firing, FIRE, financial independence, retire early. So you're going to stop working at 45. You got, 15 years until you can tap your tax deferred accounts without 10% penalty. One way to get access to them ahead of time without 10% penalty is by doing Roth conversions. Remember, I just said Roth conversions, you have to wait 5 years until you can take that converted money out without penalty. So ladder would be, I plan on stopping work at 45. I'm 40 now. I'm going to need money. Majority of my money is in my tax deferred account. How am I going to get it? Well, you can start doing conversions. So now let's say I'm going to need 100 grand a year to live on. I would convert $100,000 today when I'm 40. So in 5 years, I can take that 100,000 out with no penalty. There won't be tax owed either because I already paid tax when I converted it. By waiting 5 years after the conversion, there's no penalty on taking it out. So I'll convert 100,000 now when I'm 40. I'll convert another 100,000 next year when I'm 41. Another 100,000 the following year when I'm 42, et cetera, et cetera. So when I hit 45, I'll have 100 grand laddering, 100 grand every year. I can pull out of my Roth IRA without tax or penalty because I already taxed. It was taxed when I converted, and I waited 5 years to avoid the 10% penalty. That's a ladder. Hopefully that makes sense. Whoever answered that. Tressa Wood, Idaho, I guess, has 6% sales tax and 6.5% income tax for dollars over about 11K. Yeah, so that's not super low. It's actually fairly high. 6% sales tax, I guess, is reasonable. Coming from New Jersey, it's 6 5/8. 6.5% income tax, fairly high, I guess. Yeah. Oh, right. Cody, I forgot. So next week is the Cody Garrett Show. I won't be here. I'll be watching online. But so the second Wednesday of every month is the Cody Garrett Show, where he will talk about a specific part of the financial planning process. He uses real live documents or fake documents, but like real looking documents to show what he looks at when he's going through financial planning and reviewing stuff with folks. So next week will be how to review a pay stub and employee benefits, including FICA and cafeteria plan education. Awesome. So definitely check that out next week for the Cody Garrett Show edition of Taxes and Retirement Live. Ooh, 4% rule. Michael Kitces says 4% still good. Morningstar says 3.3%. Wade Pfau, something even less. I thought I heard 2.29. Your thoughts? Yes, whoever this is, listen to my podcast. So I forget what episode it was, episode 2, perhaps. You can find it on all your podcast platforms: Apple, Google, Spotify, Pandora, Stitcher. 4% rule is flawed to start with. It was never meant to be an actionable, implementable withdrawal strategy. It was just a sort of hypothetical academic musing about using historical data. This was up through 1994 when it was done. Using historical data under the worst string of 30 years from 1926 onward, what was the most amount you can pull out, even under the worst scenario, where you pull out a certain amount one year and every year you increase that a little bit by inflation? And the answer is 4% based on historical findings. Now that was worst case to start with already. So that's already fairly conservative. And that includes things like the Great Depression and stagflation of the 70s and World War II. So there were some really nasty, gnarly scenarios in there that the 4% still held up. The debate and the buzz now is, well, yeah, that's all well and good, but stock markets are at historic highs, and they've been, for like 10 years now. And bond markets are super low, or bond markets mathematically can't possibly return as much going forward as they have over the last few decades. Long story, but because interest rates now are so low, bond returns are a function of interest rates. When interest rates are as low as they are now, bonds simply can't return a lot. So the logic is, going forward, we don't see how 4% is going to hold. Stock returns probably aren't going to be as high as they've been historically, and bond returns mathematically can't be as high as they've been historically. So therefore, Morningstar has said, based on their guesses about what the future may hold, they think 3.3% is the new sort of most conservative withdrawal rate. Wade Pfau, I think he said 2.5-ish. Again, based on his guesses, based on his speculation about what the future may do, he thinks 2.5. Who's right? Nobody knows. The future will say. That there is a defensible case to be made that 4% may be too high, just again, based on where we're at now with how high equities are valued, and the math around bonds and how low interest rates are. But I don't know. I'm not that concerned because in practice, no one practically follows a rigid 4% withdrawal rule anyway. Life doesn't happen like that. Spending doesn't happen like that. Like Frank mentioned before, the next 10 years or whatever, he's going to be pulling fairly large amounts out of his portfolio because he didn't yet start Social Security, but he's doing it tax efficiently. 4% rule and all these rules don't factor in taxes at all. If you do things tax efficiently, you can squeeze out that much more benefit from your money. And Frank's payoff's going to be in 10 years when he starts Social Security, his portfolio withdrawals are going to drop precipitously because he will have maximized the Social Security. So he's going to have, let's just, I don't know, I'm making up a number, 5-6% portfolio withdrawals between now and 70. Once he hits 70 and Social Security starts, his portfolio withdrawals may drop to like 2%. So you blend it out over his life and he could be good. So in practice, almost no one sticks to a rigid fixed percentage withdrawal every year. So these rules are kind of out the window anyway for that reason alone. You have to be somewhat flexible and dynamic. Your spending is going to naturally be kind of variable anyway. It'll naturally, for most people, be higher in your younger years of retirement as your mind and body are healthy. You're out traveling, playing pickleball and doing fun stuff. And then over time, your mind and body slow down. So the discretionary expenses start to taper off. Now, they may or may not be partially or fully replaced by medical expenses going up. But the point is spending is kind of lumpy throughout retirement. So 4% isn't feasible. That's why I said it was nothing more than kind of like an academic musing, just to be like, I wonder if hypothetically, looking backwards, what would have been a stable, consistent withdrawal rate that wouldn't have run out in 30 years. 4% was that answer. So I'll stop there. Check out my podcast. I have a little more focused thoughts on it there than my kind of ramblings now. But I'm not that concerned. But yes, there definitely is a case to be made that it could and should be something slightly lower than 4%. But again, no one really spends on a fixed linear thing for 30-something years. So you kind of have to throw these rules out anyway, that they're really just back of the envelope litmus tests. The reasonability checks. Like if you have $1 million of savings and your plan is that you need 80 grand a year of income, that's not safe. I would assume that's not going to happen for 30 years. That's an 8% withdrawal rate. Almost certainly that's not going to last you 30 years. But if you have $1 million portfolio and you need to take out 45 grand a year, 40 grand a year, the 4% rule will say, yes, you're at least within the realm of reasonable. Be flexible. If there is a bad string of returns for a few years, you may need to taper back expenses a little bit. But if you're starting by pulling out 40 grand, 45 grand a year, that'll probably be okay. Just know that you may need to adjust down the road a little bit. So that's what you use these rules for. They're not live and die by them. They're just sort of starting points, if you will. This is in response to Cody's question. Okay. I really want to retire, exclamation point. Oh, yeah. Oh, Cody, thank you. So, Cody, this is the link to my 4% rule podcast. Thank you for that. Oh, Mark Troutman, love it. Andy's podcast on the 4% rule is one of the best explanations of the research that led to this rule. Absolutely worth a listen. Exclamation point. Thank you, Mark. Fantastic vote of confidence there. Question. Made a 2021 non-deductible contribution to a traditional IRA, subsequently transferred the contribution out of traditional IRA to a brokerage account before the deadline. I thought this was considered an excess contribution. What are the tax or penalty implications? Hold on, let me unpack this. Made a 2021 non-deductible contribution to a traditional IRA. Okay. That's fine so far, I think. Assuming you had earned income, you can do that. Subsequently transferred the contribution out of the IRA to a brokerage account before the deadline. I thought this was considered an excess contribution. What are the tax? Okay. So was it actually an excess contribution? Yes or no? If it was, then yes, then transferring it out to a bank or a brokerage account is how you would undo the excess. But how did you transfer it? Did you just simply do a distribution yourself from the custodian's website, or did you call them up? There is a formal return of excess process you have to go through. So the custodian distributes it and codes it correctly for tax purposes. If you just do a normal distribution, it's going to look like it's a normal distribution, and that's almost certainly not what you're going for. But if you did go through the custodian's removal of excess process, they will send you out the contribution amount and any earnings attributable to it. And they'll do that almost always. They'll do that calculation for you of what the earnings were on that money, or loss if you had a loss. The tax implications are if you, let's say you put in $7,000 and you weren't eligible for any because you had zero earned income. All 7,000 was an excess contribution. And let's assume while the money was in there, it grew to 8,000. The custodian will send you out $8,000. The 7,000 of it, that was your initial contribution, will be tax and penalty free to you. But the $1,000 of earnings you take out will be fully taxable at ordinary income tax rates. And if you're under 59.5, you'll also have to pay a 10% early withdrawal penalty on it. You can't get around those things. You may, but let's assume you can't. In most cases, you can't. So those are the tax and penalty implications. If you're over 59.5, no 10% penalty, but you'll still have to pay ordinary tax on any gains. If you have a loss, so you put in $7,000, all of it was in excess. While it was in there, it dropped to $6,000. The custodian will send you back $6,000. You have no tax nor penalty, nor do you get any benefit or deduction. The $1,000 loss, you simply have to eat it. There's no tax savings or anything for it, but you don't owe any tax or penalty on it either. So that's the tax implications. Now, if it wasn't actually an excess, you took it out because you thought it was an excess and it wasn't. If you took it out as a regular distribution, it would be treated like a regular distribution. If you took it out you had the custodian process it as an excess contribution, I don't know what happened. If it wasn't a legitimate excess, like you were able to make it and you took it out as an excess, I don't think the IRS will, I don't know if they'll make you put it back if it wasn't actually an excess. You'll probably get to keep it out as an excess. You have to pay tax and penalty, like I just mentioned, tax and penalty on the gain. And that should be it, I think. So hopefully that was your question. What's this? The 3.25% rules all have different asset allocation bases. Anyway, I think no one actually follows any such rules. Do you know of any one? Do I know of any one person that follows them, or do I know of any one such rule? So yeah, this was also addressed in my podcast, at least in reference to the 4% rule. The assumption was the portfolio was half stocks, S&P 500 to be specific, and half intermediate term U.S. Treasury notes. Most people have more than just the S&P 500 in their stock allocation, and most people have more than just U.S. Treasury notes in their bond allocation. So that right there also means the 4% rule isn't entirely reflective of what people do in practice. But that was kind of the findings, 50%. The 4% rule, as originally researched and published in 94, said stock allocations anywhere from 50 to 75%, all more or less had the same results. Not to say it didn't matter, but they all sort of functionally did the same. If you had less than 50% stocks, you weren't taking enough risk and risked running out of money. If you had more than 75% stock, you're taking too much risk and risk running out of money because, too much risk versus not enough risk. So those all assume the typical sort of blended portfolio, 50-50 or 60-40 stocks to bonds. But yeah, to your point, different people have different allocations, whether because they're gamblers at heart or super conservative at heart, and they're going to have a 40-60, 40-60 stock to bond allocation, or an 80-20, just simply because they like the risk. So these rules can't really be applied in practice. Again, they're starting points, they're academic theory, if you will. They're not practical, implementable distribution strategies, in my opinion. We're 9 o'clock. Looks like this is the last question for now. If anyone else has any other questions, feel free to drop them in. Are there any tax issues unique to 55 and over communities, or is everything treated just like a non-55 community? I don't know. I think they should be like anything else. Property taxes, potentially deductible on your tax return. Mortgage interest, if you have a loan to buy the place, potentially tax deductible on your return. Property insurance, no. HOA fees, no. If you own one as a rental, then yeah, you can deduct the related rental expenses just the same as if it's a non-55, I think. So I don't think that matters. Where it would start to matter, and I don't think this is what you asked, but just thinking out loud here. If you buy into a continuing care retirement community, these are one of the things where there's different stages and phases. As your life progresses, you'll start you buy into the community, and you start in you're fully independent, sort of 55 and older type place. You have your own quarters, you do everything yourself, your own shopping, your whatever, you drive to your doctor appointments. As your mind and body slow down, you move into different living arrangements within this community. So then there'll be some slightly assisted living where you're still in your own kind of apartment or whatever, but people check on you once a day. Maybe doctors come to you instead of you go to them. Then at some point, if you really progress, then you're in like the full sort of nursing home facility where you're kind of bedridden and you have doctors and nurses, by your side throughout the day. When you get to that point, then some of the fees that you're paying or you already pay, I don't quite know how it works. I guess they're all slightly different. But point is, some of your expenses will be qualified medical expenses for this, nursing treatment and the doctor visits and stuff. Then, at least some of your expenses to be part of this community will be deductible, potentially deductible as medical expenses. Outside of that, though, no, I don't think there's anything special from a tax perspective about over 55 communities versus just a normal house or normal community. Defaults, yes. 4% rule is based purely on U.S. returns, just the S&P 500. Again, it was also just the S&P 500, so the 500 largest companies. It did not account for small and medium-sized U.S. companies. And the founder, I won't call him the founder, but the guy, Bill Bengen, who did the 4% rule, said himself he had gone back and sort of kicked around other data. If you were to have included small U.S. companies, the results would have been even better. Because they had better growth over the long term. So that right there, most people do have a diversified portfolio of more than just large U.S. stocks. So in theory, that right there supports something that would be higher than 4% rule. Again, no one knows. It's all premised on what your guesses are about the future. Morningstar's guesses based on what they think inflation will be, what they think stock and bond market returns will be. They think 3.3% is the new 4%. But again, that's just their guesses. There's no science around it. Well, I mean, there's science, I guess, in how they came up with their guesses, but it's all just guesses about the future is what's driving their 3.3% recommendation. All right, 9:03. I'll stick around another 30 seconds for the fun of it. If anyone else has any other questions, again, next week's topic is the Cody Garrett show. I'm just looking at the rest of the schedule. I don't even know what's coming up. Followed by, where'd it go? February 16th, equity compensation with Meg Bartelt. So anyone, this may not apply to most of you, especially if you're retired, but anyone who has equity compensation, stock options, non-qualified, incentive stock options, restricted stock units, performance stock units. If you work at a company that's IPO or pre-IPO or going IPO, that's Meg's wheelhouse. She focuses on working in women in technology, specifically as her niche. And along with that is a lot of equity-based compensation. So for those of you interested in options and equity comp, February 16th, special guest Meg Bartelt. Next week, again, the Cody Garrett show, talking all about paychecks and employee benefits. February 23rd, topic deep dive into indexed annuities. Man, that's going to be a barn burner, that one. Definitely, even if you're not interested in annuities, you'll be interested in that because these products are so cool, I think, in how they're structured. Now, I'm not saying they're good or bad. I don't mean that by cool. They're funky and they fascinate me. So that'll be a good one. Where are we at? Any other questions? No. Okay. All right. Cody Garrett's got a new podcast for those of you who didn't notice. So his podcast is really focused on other advisors, sharing knowledge and process and Cody's experiences with other advisors, because dude's got a hugely gracious heart with sharing knowledge about his experiences and his path. So that's definitely an interesting one to check out. Measure Twice Money, Cody, is that the name of it? Measure Twice something. Measure Twice Podcast. Measure Twice Sounds. Measure Twice something with Cody Garrett. Definitely a fun one. All right, that's it. Thank you all. Great questions. Sorry, I kind of stumbled or didn't know some of the answers, but hopefully you at least found the stuff I did know useful and got something out of it. And here's the link to Cody's podcast. Here we go. Buzzsprout. Awesome. All right, that's a wrap for tonight. Thank you all. I won't see you next week. Cody Garrett will see you next week. I'll see you the week after that. Take care.